Exercise 307 is still talking about tax. Now, in Australia, we have two compulsory forms of tax, income tax and the Medicare levy. Now, both of those are based on your taxable income. And you've already done an exercise where you have worked out taxable income and used the table to calculate the income tax. Now, there's more to the story than just the table and the calculating taxable income. For those of you who have a job, and remember we talked about this in class, on your pay slip, it may indicate that you have paid some tax. Some tax has already come out of your gross wage. The tax has been taken out of your gross wage and you collect your net pay. So what is that tax that's come out of your pay? In Australia, we call that tax that comes out of your pay, we call it this, pay as you go, and you'll often see that written as pay as you go with a T on the end, pay as you go tax. So we pay our tax as we go. That just means through each week. We pay our tax each week or fortnight, and it comes out of our gross wage automatically for us. You might be thinking then, well, what does the table and the income tax that we've just been calculating in the previous exercise, where does that come into the story? Well, that's what you use to determine whether you've paid enough tax or not. Now, this pay-as-you-go tax is something that's calculated by the person who employs you, and they're taking it out of your wage and they're sending it away to the taxation office. If they're sending away enough money for the total gross income you'll earn over the entire year, then that's great. The amount that you will have paid as this pay-as-you-go tax hopefully will equal what the table says, and the table is set by the government, so there's no altering that. If the table says you have to pay $2,000 in tax, and you have paid $2,000 in tax, then everything's good. But if you haven't paid the amount of tax the table says, mind you, this is based on your taxable income, then if you haven't paid that amount, then you have to pay the taxation office more money, or whatever to make up to what the table says is your tax bill for the year. So the tax bill is different for everyone, or the amount of tax people pay is different for every single one of us. The amount of tax you pay depends on ultimately your taxable income, which might be for a lot of you, your gross income. But your gross income is different to probably everybody else's gross income because it depends on how many hours you work. Now, it's important, I believe it's important for you to understand the steps throughout a working year. In terms of how much we actually pay, and then whether we get a tax return, a tax bill, or we don't have to do anything except lodge a tax return. So what happens? During the working year, tax is deducted from your wage, It's paid directly to the taxation office for you, and it is known as pay as you go. At the end of the financial year then, which we know to be June the 30th, you receive this group certificate which indicates how much tax has been paid to the government on your behalf. What is also on there, on this group certificate, is your gross income. And from that value, you can work out your taxable income. Now, if you don't have any allowable tax deductions, those two are the same. So what happens after that? You then calculate the total amount of tax you're expected to pay. How do you do that? Just like you did in the previous exercise, you look at the income tax table. That's why it was so important that you mastered using that table in the previous exercise. Now, that's not all of your total taxable income plus your Medicare. And we know the Medicare levy currently in Australia is 2% of your taxable income. Now, so you've got the total amount of tax that you are expected to have paid. But what has happened for you? Some of this tax has already been sent off to the government for you on your behalf. So what you're hoping is, whatever this total tax number is that we've calculated using the table and the Medicare levy, is less than or at least equal to, what has been paid on your behalf. If that's the case, then everything's good. You've already paid the amount of tax that the government is expecting from you. However, if the amount of tax you've paid is more than this total tax, you will receive a refund. Lovely. If the amount you've paid is less than the amount that you should, you will receive a bill, and this situation is best avoided. We've already talked about the Medicare levy being part of total tax, and in Australia it is 2%. I'm going to stop the video there and do the example in another video.